Well, first of all, thank you everyone for joining us today on our Bitcoin Masterclass, which is organized within the Institute of Directors with Finance and FinTech Group, and also with the company ICONOMI. First of all, I would like to say sort of few things about the Institute of Directors. Institute of Directors has been established in 1903, and in 1906 it received the Royal Charter, which means it has the initiative from government to work on governance and advise companies on governance. We have over 20,000 members within UK and also internationally. The Institute of Directors offer a range of courses within sort of the directorship to become chartered director. My name is Yvonne de Ville, and I'm the chair of the Finance and FinTech Group in the Institute of Directors. And our group specializes especially within the finance and fintech sector, and we aim to be the center of excellence. We work on three pillars. Number one, which is sort of the collaboration, working with businesses, not only within the Institute of Directors, but also outside. Number two is the sort of sharing knowledge, the education, sharing ideas, and this is where we where we're holding the webinars and events and do panel discussions. So if anyone ever wants from our audience be included in those, please do let us know if you have any great ideas, what other subjects we can cover. We also work with the IoD policies and UK government on the finance and fintech ecosystem. And if any of you are not yet members of IoD and members of our finance and fintech group, please do reach out to David, who is with us today and is organizing and supporting this webinar. And David can give you all the details about all the wonderful benefits that the Institute of Directors offers. So please do feel free to reach out. Today's session will be about Bitcoin, and it will last for about an hour. And at the end of the day, you will have the opportunity to ask questions, and we will enable the chat where you can put your questions there. In the matter where we won't have enough time to answer the questions, we can also respond to you via email. So if there are more questions that we can cover, don't worry, we'll definitely would like to get back to you with the best answers. So please don't feel shy and put them there. And our speaker today, our expert is Anthony Fernandez, who is the head of business development and ICONOMI, which is a digital asset portfolio management platform. So Anthony began his journey back in the day in the wealth management with traditional investment platform. He progressed through sort of fintech and wealth management route into the alternative investment space. Anthony now specializes in Bitcoin, digital assets, and microeconomics. Today's webinar, we will cover what is Bitcoin, a little bit about blockchain technology, proof of work, proof of stake, macro economics, CBDs, Bitcoin versus dollar. We will also talk about the 4-year Bitcoin price cycle. And lastly, why should you as a business owner have Bitcoin in your portfolio? So Anthony, please tell us what is Bitcoin and what do we really need to know about it?
Hi, Yvonne. Firstly, thanks for the warm introduction. Hopefully I can provide some value today in terms of what Bitcoin actually is. And before I answer that question, there's quite a bit of information to get through. So it's quite a complex question, I guess, which I'm going to try and simplify. And just so everyone's aware, we're going to be focusing on Bitcoin technology at the start. During the middle of the presentation or webinar, we're going to go into more macroeconomics because Bitcoin is essentially a risk asset and is relied it does heavily depend on what's happening around the world and the global economy in terms of how Bitcoin is going to perform, as well as Bitcoin's 4-year price cycle and the halving event next year. So during the later stages of the webinar, there's going to be a lot more charts and some more graphics, I guess, for everyone to look at, which is a bit more visual. So please bear with us. We're going through and we're going to present, I guess, what Bitcoin actually is. So let me just get my slides up. Great. So can everyone see? Can you see my screen there, Yvonne?
Yes, sir. Yes.
Perfect. So let's touch on what Bitcoin actually is. So here are a couple of like loose terms which have been floated around that you'll see online. So, it's a hedge against inflation. It's a hedge against economic uncertainty. It's a hedge against government overreach. It's a hedge against a fiat currency collapse, a hedge against, I guess, banking failures, which have been, at the forefront of the news, especially in the US over the past year. And there's some people online saying it's still a scam as well. So hopefully, as we go through this webinar, we can go through some of the myths and some of the statements above, and we'll either debunk them or provide value on some of those statements as well. So just to start, I guess, Bitcoin is essentially the world's first cryptocurrency. It went live in 2009. It was built by a computer programmer or a group of programmers under the name of Satoshi Nakamoto. Now, unlike every other form of traditional payment, Bitcoin works without the need to trust a central authority or a middleman, like a bank or an institution, to send money. Now, Bitcoin lets you send and receive value to and from anyone in the world with only a computer and an internet connection. Now, without the need for a corporation, Bitcoin is the world's first public digital payments infrastructure. Public meaning it's available for all, and it's not owned by a single entity. So really what's happening here with Bitcoin is it's taking control away from central authorities like governments and central banks and putting it back into, putting the power back into people's hands. They have control over their Bitcoin. They can become a miner who can then generate Bitcoin on the side, and they can then contribute to the network. So it's really a case of removing control from central authorities and putting it back into the hands of everyday people in the world. Now, Bitcoin was created in order to eliminate the need for third parties to be involved in financial transactions, a virtual currency that can be used as money and as a means of payment without being under the authority of any one person, group, or entity. Now, Bitcoin is still relatively new in its lifespan, so there is still a lot of volatility in the Bitcoin market, and it's definitely not a perfect alternative to using US dollars, pounds, or euros for a means of payments transfers. But I guess at the moment, Bitcoin is a decentralized digital currency that operates without a financial system or government authorities. It utilizes peer-to-peer transfers on a digital network that records all cryptocurrency transactions. It's a cryptocurrency that can be purchased on multiple platforms. It's paid out to blockchain miners in exchange for their efforts in verifying transactions. And Bitcoin miners are key to the success of the network. We're going to touch on Bitcoin miners in a second, but essentially you are rewarded for providing energy to the network. If you don't want to contribute energy to the network to prove in transactions, you can still own and send and receive Bitcoin as a form of payment.
Mm-hmm. So Anthony, how does the Bitcoin work without the need of the bank or corporation?
Sure. So if we take me and yourself, Yvonne, we can send and receive money to each other directly without it having to go to a third party like a bank. So if I was to send you money, I would log into my bank. I would then put your payment details in or your banking details in, which would be maybe the same bank or a different banking entity. They would then verify that transaction and send it to your bank there as well. At the moment, yes, those transactions are relatively quick. It could be a couple of hours. It could be a couple of days, depending on the size of the transaction. But you're really relying on the third party or the bank to approve that transaction. Now, if you take in the news recently, Nigel Farage, whether you like him or not, agree with his views or disagree with his views, he was recently debanked here in the UK. And, that type of activity of debanking isn't available in the Bitcoin market. So you're essentially your own bank and your peers are validating your transactions. So the Bitcoin miners around the world are proving the transactions, validating the transactions, and they go through virtually instantly and very cost effectively as well.
Okay.
Now, just a couple of Bitcoin facts before we go any further. So there are some important numbers here for everyone to remember. There's only ever going to be 21 million Bitcoin. Now, these Bitcoin become unlocked as blocks of Bitcoin become mined and the transactions are proved. Now, the last Bitcoin won't be mined until the year 2140, roughly. So out of our lifespan, most likely. Now, currently, there has been just under 19.5 million Bitcoin has been mined since its inception. There are currently 1.5 million Bitcoin unmined, and every 4 years, the amount of Bitcoin that can be mined is cut in half, which is known as the Bitcoin halving event. So the next Bitcoin halving event is due to be in April, May 2024 next year, so roughly 8 to 9 months away. Now, at the moment, on average, 144 blocks of new Bitcoin are mined per day, and each block contains 6.25 Bitcoin. So at today's rate, there's roughly 900 new Bitcoins being mined and entering circulation every single day. After the next Bitcoin halving event in April, May 2024, that's going to decrease to 3.125 Bitcoin. So instead of 900 Bitcoin per day going into the market, that's going to go down to around 450 Bitcoins per day. Now, the next slide is an interesting slide as a visual. So this is a chart of Bitcoin in black, and the orange line is the halving rewards. So these are the rewards that miners receive. And as you can see, every 4 years, the rewards are cut in half. So what this does is there's a major supply and demand shock in the market. There's less Bitcoin going into the market, 50% less than the term previous. So if we take a look at the first halving rewards in 2013, the block rewards reduced from 50 to 25 Bitcoin. In 2016, the block rewards reduced from 25 to 12.5. In 2020, the block rewards reduced from 12.5 to 6.25. And next year, it's going to reduce to 3.125. Now, what this also suggests is the Bitcoin halving event is in the retail market, it's actually known as the catalyst for the bull market. However, Bitcoin actually bottoms a lot sooner than the halving event. The halving event generally is when investors come out from the woodworks, they start buying digital assets and Bitcoin, because the halving event has generally signaled the start of the new bull market. But in a few charts towards the end of the presentation, we're actually going to analyze the market in a bit more detail. And we're going to show how Bitcoin actually bottoms roughly 400 days prior to a halving event as well. So this is just a good visual on how the halving rewards actually impacts the price of Bitcoin and why that's important to the, I guess, the tokenomics of Bitcoin. And we'll come on to fiat currency later. You know, fiat currency has this endless supply of, central banks continuously print money, which devalues the fiat currency. Whereas Bitcoin is completely different. There's only ever going to be 21 million, and it won't be mined until 2140. So there's the opposite kind of effect with Bitcoin compared to fiat currency. It's very scarce. It's the supply is reducing every 4 years. And at the moment, there is a race to see who can accumulate as much Bitcoin as possible. So let's just touch on the blockchain structure. A very, very simple graphic, essentially transactions on the blockchain. So if I was to send you money, Yvonne, that would go into block 8, and miners around the world would be looking to solve that transaction. So altogether, they are validating and proving those transactions, which is called proof of work. So they're providing energy to the network, they're supporting the transactions. And once block 8 has been validated and all the transactions have been verified, the unmined Bitcoin is released to the miners that have supported that block of being mined. Okay, so if we just take a look at this section here, so in computer terms, a block is a data packet that can be transmitted across computer networks. When strung together with other blocks, they can become a virtual chain known as a blockchain. Now, what keeps this data safe and secure is that each block on the chain remembers and recognizes the blocks in front and behind it. So if I was to hack, or if someone was to hack the blockchain, they have to hack the block before and after the transaction, which means it's a full circle kind of a loop. If I was to hack block 7, and commit a fraudulent transaction, I would also have to hack block 6 and block 8. Now, for me to hack block 6 and block 8, I would also have to hack block 5 and block 9. And it's an endless loop. So you'd actually have to hack the whole blockchain to be able to commit a fraudulent transaction. So that's why it's so secure.
Mm-hmm. But so Anthony, a question for you. So why does the sort of cryptocurrency and Bitcoin has actually got an association with the very sort of a lot of criminal activities?
That's a good question. So at the very, it's quite the opposite, really. You know, with blockchain, you can go and you look at the transaction ID. It's validated online. You can see where the money's gone to. You can see exactly how much money has been transferred. So, you know, I think it was the BlackRock CEO Larry Fink came out and said Bitcoin was for money laundering and criminal activity back in 2017, which maybe in the early infancy stages was true. But if you're using it now for money laundering and criminal activity, it's probably very, very easy to get caught because all the transactions are online for everyone to see and to validate. So it's kind of a misconception that blockchain or Bitcoin in particular is being used for criminal activity. Quite the opposite. It's a lot easier to use fiat currency to commit fraudulent transactions than it is with Bitcoin, for example. So just touching on the hacking again. So basically, the blockchain will reinsert a copy of unaltered block data stored in the data packets in front and behind it to avoid being caught. The criminal must hack the block in question and the ones in front and behind it along the entire chain. So it's a full looped chain that you have to hack to commit a fraudulent transaction. So we'll just touch on proof of work versus proof of stake. So proof of work has been associated with Bitcoin. Proof of stake is associated with cryptocurrencies like Ethereum, which moved from proof of work to proof of stake recently. Now, Bitcoin relies on computer power to solve problems and solve transactions on the blockchain. These computers are known as miners. Now, as Yvonne said previously, so I worked roughly in the Bitcoin mining industry for roughly 4.5, 5 years in Australia. And that's where I gained a lot of in-depth knowledge about the Bitcoin market. Now, Bitcoin mining has this misconception that it's a very energy intensive, which it is. It's bad for the environment. It's contributing to the energy crisis globally. Now, I would argue that actually Bitcoin mining is one of the greenest industries in the world. Roughly, it's estimated 60 to 70% of Bitcoin mining is run on renewable energy. And that's crucial. Otherwise, it wouldn't be valid or viable for someone to mine Bitcoin at the ludicrous prices that are seen around the world at the moment, especially the energy prices where they were last year. So Bitcoin mining to be done at the institutional level has to be done on renewable energy. Now, furthermore, Bitcoin mining also supports the grid. What you see in America, for example, in let's take Texas, because Riot, a company based in Texas, are a Bitcoin mining company, they support the grid. They received roughly $31 million in tax credits because they supported the grid and redirected energy from the Bitcoin miners towards the Texas grid during the previous heat wave where their grid had instability. So if you take a look at the grid, for example, you have a surge in demand early in the morning where people are getting ready for work. And you have a surge in demand in the evening when people are home from work and they're getting, I guess, they're watching TV and they're socializing in the evening. Whereas renewable energy, it generally captures the majority of its electricity during the day, especially solar. So you have a kind of an imbalance there. You have a demand in the morning and evening, but you have supply coming in during the day. So what Bitcoin mining does, it attempts to stabilize the grid by creating a more steady demand of energy coming from the grid. So you generally can't store solar energy in large tranches. So Bitcoin mining has the ability to use up excess energy that was actually going to be wasted during periods of low demand and redivert the energy back to the grid during times of high demand outside of the solar company's capacity to provide it, especially at night or during the morning. So the miners are, I guess, coming back to the miners, the rewards a miner receives depends on how much power they provided to the network, also known as the hash rate. But there is a trade-off between energy costs and Bitcoin rewards. Now, just touching on proof of stake. So Ethereum has moved from proof of work, so mining, to proof of stake. and it relies on Ethereum holders to stake their tokens on the network in nodes, which validate transactions. So these nodes communicate like miners and they prove transactions. And the nodes are rewarded with cryptocurrency for every correct validation. Now, as a safeguard against fraud, proof of stake protocols require traders to stake some of their cryptocurrency as collateral, which is then locked up in a deposit. If a trader adds a transaction to the blockchain that other validators seem to be invalid, they can lose a portion of what they staked. So you have these two different mechanisms. And however, proof of work is truly decentralized because not one entity owns Bitcoin mining. There are hundreds of thousands, if not millions, of individual miners around the world now, all contributing to the network. Whereas proof of stake with Ethereum, you can have a small number of entities that can own the majority of the nodes, which can then validate false transactions. So Ethereum, although it's now using less energy, it's become less decentralized and it's now susceptible to potential hacks or to potential corruption, I would say. Just a couple of keynotes here as well. So Bitcoin is not free to produce like paper money. It requires energy and computer technology. We mentioned previously, so the last Bitcoin won't be mined until the year 2140. Once the last Bitcoin is mined, it's going to move from being rewarded in unmined Bitcoin to being rewarded more in transaction fees. Mm-hmm. Now, Bitcoin has already been adopted as legal tender by 2 countries around the world. Bitcoin's not owned by a single entity. It removes control from the money supply away from central authorities. Mm-hmm. Now, since inception, Bitcoin has an annualized return of roughly 150%, 145% per year. And that's despite the correction that it has of roughly 80 to 85% during the bear markets.
Okay. Anthony, can I ask you, so who has decided that certain amount of Bitcoins can be mined in second time, and who's decided on the number and the sort of the year when it will be stopped?
So it's all dictated in, I guess, Satoshi Nakamoto. That's the easy answer. Mm-hmm. Now, the more in-depth answer is it's determined by the number of miners coming online. So the more miners that come online, the harder it becomes to mine. So that means less supply going into the market. The less miners, so let's say miners come offline. So mm-hmm. back in 2019, China actually banned Bitcoin mining. That was where roughly 50% of the world's Bitcoin mining was done in China. They banned Bitcoin mining. So what happened was the hash rate, the overall number of miners online, decreased by 50%. Now, in that same couple of weeks, the miners that were left online, their rewards went up dramatically because there was less miners online. So they were getting a larger share of the pool. Mm-hmm. All those miners migrated to different areas like America, Europe, and other areas in the world, South America, to continue their operation. But yeah, the easy answer is Satoshi Nakamoto or the group of programmers decided that these tokenomics were essential for longevity of Bitcoin and for the stability of price appreciation over the longer term. Okay. So a bit of it's determined by the number of miners and also the code and the algorithm that's been coded into Bitcoin at the start. Mm-hmm. Okay, so we could take a breath there. That was a quick overview, I guess. What is Bitcoin? What is blockchain? There's going to be, a few slides here we're going to go through in terms of macroeconomics, because this, understanding macroeconomics is going to help you understand what's actually driving the financial markets as a whole, and why Bitcoin is also reliant on certain outcomes in the financial markets as well. So before we go any further, I think it's important just to recap a few of the major events that have happened around the world over the past couple of years. So we've had, obviously, the pandemic, COVID-19. We had a global economic shutdown and a reopening since then. We've had numerous government and central bank interventions. We've had surging inflation. We've had one of the most aggressive interest rate hikes in history. We've had a global bond market and a stock market crash at the same time, which is very unheard of. We've had a US regional banking crisis, roughly 5 regional bank failures, Credit Suisse here in Europe. We've had an FTX collapse, one of the largest cryptocurrency exchanges in the US. We've had numerous fiat currency collapses, or some that are on the verge, and issues with different fiat currencies. Obviously, the Russian invasion of Ukraine, which is hurting supply chains around the world. We have a potential economic crisis unfolding in China. Their property market declined by roughly 9% last month alone, and property makes up roughly 30% of China's GDP. We have unemployment rising in China as well. We also have the rise of the BRICS nations, which is Brazil, Russia, India, China, South Africa. And from that, we have a global de-dollarization theme picking up momentum at the moment as well. So I guess we'll touch on fiat currency. This is probably one of the reasons why Bitcoin was created. So there's been over 775 fiat currencies in human history. Average lifespan of a fiat currency is around 27 years. The US dollar has actually been serving as a global reserve currency for roughly 90 years. Now, a fiat currency will collapse when the faith in the stability or usefulness of the currency as a store of value or medium of exchange ceases. Central banks have the ability to print currency and provide the economy with liquidity, which is known as quantitative easing. Quantitative easing is a euphemism for printing money through a central bank's open market operations. The purchase of government bonds is used to increase the money supply, and I'm going to come on to why this is so important later. The most prominent case for quantitative easing worsening inequality stems from financial asset price appreciation and its implication for household wealth. So when a central bank prints money, that money indirectly flows into risk assets or property, stocks, bonds, cryptocurrencies, which widens the gap between people on the lower end of the economic spectrum and the higher end of the economic spectrum. Working class or people at the lower end are people that tend to not invest in stocks, equities, bonds, property, because they simply can't afford to. And people at the higher end, they store their wealth in those particular assets. And quantitative easing, I guess, indirectly supports a widening of that gap because the liquidity flows indirectly into those assets. Here is just a chart that's quite hard to get your head around. So we've since the 1960s to 2010 or 2008, when the financial crisis was, we've had a steady increase in the M1 money supply, which is US dollars printed in existence. Obviously, we had the 08 financial crisis, and from 2010 to 2020, we had a large rally, I guess, increase in the money supply. But when COVID-19 happened, the Federal Reserve actually printed 80% of all US dollars in existence in a 22-month window. So it went from 4 trillion to north of 20 trillion in under 2 years. And it's just so hard to get your head around that amount of money. And that liquidity has to flow somewhere, and it flows indirectly into risk assets. So yes, you as someone at home, an employee, you may have had a stimulus check from the government of £1,000 or £2,000, but that really comes back to bite you later through inflation and through prices of assets and commodities going through the roof. And here's just a simple chart. So we've got gold, Bitcoin, the NASDAQ, and the S&P 500. So we had an initial market crash as the global economy stood still. We then had central banks slashing interest rates to zero, the Federal Reserve and other central banks around the world providing stimulus to the tunes of literally trillions. And those, I guess that liquidity flowed indirectly into assets like gold, Bitcoin, NASDAQ, and the S&P 500. Bitcoin was actually one of the major beneficiaries of that liquidity. And it's also one of the reasons why it's suffering now during the bear market when central banks are trying to unwind that stimulus. So here's just a more up-to-date chart of the M1 money supply. So now having the Federal Reserve, because of surging inflation around the world, because of the amount of liquidity in the system, where they're now trying to unwind some of that liquidity, and it's indirectly hurting the bond market, the stock market, the cryptocurrency market as well, and other markets as well. So, you know, there's this kind of saying, will there be a hard landing, a soft landing? Will interest rates continue going higher? Well, the honest truth is, if interest rates continue going higher, we're going to see more, there's literally billions wiped off the bond market, off the stock market. It's going to continue to cause more damage across all financial sectors. One thing to take a look at is the global net liquidity. So as I mentioned before, central banks are attempting to dial back liquidity provided throughout the COVID-19 pandemic due to surging inflation and the M1 money supply. And the next chart is a really interesting graphic. So it details the global net liquidity, which is the Federal Reserve, the Bank of Japan, the Bank of China, the ECB combined net liquidity against the S&P 500, which has a very close correlation. So simply put, if central banks continue to reduce the money supply and wind back their balance sheets, then we're going to see lower prices in the stock market, especially. However, if we get to a point where the Federal Reserve is going to pause interest rates, possibly taper off next year because of a potential recession, and they may need to start turning the printers on to stimulate the economy again, that will suggest that the stock market and cryptocurrencies and other risk assets could perform well because global net liquidity may increase in value. So really, a lot of risk assets are at the mercy of the central banks around the world. We'll just touch on the US dollar index because it's crucial to understanding where Bitcoin is going to be moving. So the US dollar index, the DXY, really is a risk measure in the market. If the dollar index is increasing in value, it tends to mean risk off. Investors are moving out of risk assets into safe haven, the global safe haven currency. If you look at the center of the screen, the COVID-19 pandemic, we had an initial spike higher on the US dollar index. Central banks then came out, started printing money, slashing interest rates, providing liquidity to the system. So there's a major increase in the supply. So that resulted in a major devaluation of the US dollar. So the US dollar moved from 104, 103, all the way down to 90 over a period of just 1 year, which is a really sharp and aggressive move. Now, during the end of 2021, we started to hear stories of rising inflation. The Federal Reserve may need to increase interest rates to combat inflation. We then had a major reversal on the US dollar and one of the most aggressive interest rate hiking periods in history. Once the US dollar peaked at 114, there were some news stories coming out of a potential recession. Inflation has potentially peaked. Supply chain disruptions have eased. However, what I guess the key thing to get around here is if there is a recession, what does the central bank usually do? What does the Federal Reserve usually do? During a recession, that means unemployment increases, demand in the economy decreases. And for them to stimulate the economy, they tend to need to reduce interest rates to make borrowing cheaper and to provide free cash or cheaper liquidity to the system. So that's why the US dollar index has tapered off from that high, roughly in November, December 2022, because investors were anticipating a peak in the US interest rates towards the end of this year. So yeah, we're now potentially coming towards the peak end of the interest rate hiking cycle. Depending on if a recession does hit, will determine whether or not we continue going down on the US dollar index, or whether or not the US continues to raise interest rates. One thing in the US is unemployment is still at record lows. So there's not enough pain in the market just yet before a recession to be kind of classified. Unemployment still record lows. They need unemployment to rise aggressively before they can consider really kind of changing and tapering off interest rates. A bit here on why the US dollar is really an economic risk outside of the US for other global economies. So most commodities are priced in dollars, which makes commodities like oil and wheat more expensive, which threatens the ability of some countries to access sufficient quantities of supplies. Emerging markets are also reliant on foreign investment and foreign capital, both of which can decrease when the US dollar strengthens. So when the US dollar goes up, there's a lot of pressure on emerging markets. Higher interest rates in the US makes it harder for emerging markets, nations and companies to service their US dollar denominated debt obligations as well. So as interest rates rise in the US, we're seeing a lot of foreign countries finding it hard to service their debt obligations to the US. And the majority of countries around the world have some form of US debt obligations. Now, whilst the strong US dollar and higher interest rates in the US is slowing the local inflation in America, it increases inflation for the rest of the global economy. Central banks in other countries must raise interest rates in an effort to prop up their currency, but the higher rates in that local country also weaken that economy and increase unemployment. So it's a double-edged sword. Now, whilst the weaker currency can positively impact exports, this is only the case during periods of economic strength when the demands for goods and services is high. And at the moment, that simply isn't the case. Global demand is declining around the world. China's manufacturing is decreasing. GDP has decreased recently as well. So a lot of economic contractions or economic uncertainty happening at the moment off the back of a very strong US dollar.
So, Anthony, how does this sort of economics view, the sort of global view, how is it connected to Bitcoin, and what impact it has on Bitcoin, if any?
No, yeah, good question. And we're going to come on to that in a second. It's crucial to understanding why Bitcoin can potentially serve as an alternative form of money to the US dollar, and why, I guess, in the early days, the Federal Reserve and high-ranking government officials are trying to downplay this technology, and Bitcoin in particular. Bitcoin has an inverse correlation to the US dollar index. So if the US dollar continues to devalue, which it always has over time, over a longer period, due to an increase in the money supply, that is only beneficial for Bitcoin in particular and other digital assets as well. This is just a couple of, I guess, snapshots from a few issues we've seen around the world. So, China's currency has recently fallen to a 16-year low against the US dollar. Last year, the British pound crashed off the back of some unfunded tax cuts. Argentina's peso continues to slide to lows not seen for decades. They actually have interest rates north of 100%. The Turkish lira is crashing at the moment, or has been for a period of time as well. And there is a lot of issues in Sri Lanka. I mean, these are just a few, but outside of a lot of the Western nations, a lot of pressure on the, especially on the emerging markets. Their currency is devaluing at an alarming rate, partly due to local policies, but also due to the Federal Reserve and the US dollar as well, putting pressure on their local currency. And we're now seeing in Argentina, for example, one of the front runners for the next presidential campaign is actually a Bitcoin supporter and has proposed for Bitcoin to be used as their legal tender as well. So currency devaluation around the world is pushing countries to using alternative forms of payments and money supply. Just wanted to touch on this because bonds are considered one of the safest investments out there. And 2022 was the first time in history that the stock market and the bond market faced a drawdown of this magnitude simultaneously. So we're seeing bonds getting devalued as interest rates go up, the value of the bond goes down. And at the moment, especially here in the UK, there was a number of pension companies that had to be bailed out because they're heavily exposed to the bond market. So if the Bank of England continues to raise interest rates, we're going to see more and more pressure and margin calls on these particular companies that are especially exposed to the bond market. Now, just touching on BRICS, because this is obviously crucial to the theme of the global de-dollarization and Bitcoin going over the next decade. So BRICS, obviously Brazil, Russia, India, China, and South Africa. They've recently also agreed to extend their allies and partnerships to countries in the Middle East, to Argentina. So what we're essentially seeing is a rival to the US dollar. Now, as it stands, BRICS members make up around 20% of global oil output. The addition of Saudi Arabia, the UAE, and Iran would see BRICS make up roughly 42% of global crude oil output. In addition to BRICS increasing its share of oil production, the inclusion of the nations also places significant areas under BRICS influence, including the Suez Canal and surrounding areas. So we're seeing a major shift. And if Saudi Arabia does agree to join BRICS after using the US dollar or the petrodollar over the last 40 or so years, that's going to be a major player in the global de-dollarization as less trade around the world is settled in US dollars. Now, Bloomberg Economics predicts that existing BRICS members' share of global GDP could reach more than 40% by 2040, and that's not even considering the new members that are going to take or become a part of the BRICS nations or alliance over the next year. Outside of oil, China also controls the rare earth minerals market. Production of these rare earth minerals has remained concentrated. China has dominated the whole in the market with a 60% of global production and 85% of processing capacity. And China actually refines 89% of the world's key metals for EV magnets. And that is obviously a very big push in the West. Green energy, moving away from carbon. And unfortunately, China, and who are part of the BRICS now, actually control the majority of the rare earths that go into those components of building EV batteries and magnets and green energy. So this is very concerning from a West perspective. So, outside of the BRICS nations, we have a major de-dollarization theme taking place. I don't want to obviously sit here and read all that out, but I guess the main theme here is that we're seeing more and more nations become sick and tired of using the US dollar or being forced to use the US dollar, and kind of a downside pressure forming on their economy. So they're now looking to agree to settle trade in their local currencies. Saudi Arabia is now in talks with India to settle oil trade in local currency. They've done the same in the Chinese yuan. You've got countries in Asia, Europe, and Latin America have recently announced plans to start moving away from the US dollar as their sole reserve currency and instead trade in their local currencies. Since Russia invaded Ukraine and the sanctions were put on, China and Russia, who normally use US dollars to settle global trade, they've been trading in their local currencies, and that's increased by 8,000% over the past year. So a major theme here is picking up momentum, which is global de-dollarization, which will have a big impact on Bitcoin and the US dollar in particular. So just an interesting graphic here. The US dollar has actually lost 97% of its purchasing power since 1913. And if we do fall into a recession and they have to turn the money printers back on in the near future, in the next year or two, that's obviously going to continue to devalue the US dollar. So finally, back to Bitcoin. What does this actually have to do with Bitcoin? So I appreciate everyone's patience there going through global economics. We've got some more interesting charts coming up. If we take a look at the past couple of years, we've seen major figures, especially in the US, downplay Bitcoin and digital assets. Jerome Powell, the Fed chair, saying that cryptocurrency are useless. We've had the BlackRock CEO in 2017 saying Bitcoin is an index of money laundering. We've had JP Morgan CEO Jamie Dimon say Bitcoin is worthless, which is very interesting because that was in 2021, and now 2023, we see the same institutions now looking to adopt a Bitcoin strategy, either through an ETF or an investment opportunity through incorporating blockchain into their own offering in some capacity. So even the central banks as well. Now, this is one of the most crucial charts that I watch every week, and it's a chart of the US dollar index paired against the price of Bitcoin. So what we tend to see, every US dollar or DXY, dollar index, top coincides with a Bitcoin market bottom. So when the US dollar rises in value, Bitcoin tends to go into a bear market. When the US dollar peaks and they move into a period of reducing interest rates or economic growth, a lot of positivity in the market, the dollar index cools as the global safe haven. Money flows out of the global safe haven currency back into risk assets like Bitcoin. So Bitcoin is actually one of the #1 beneficiaries of a weaker US dollar. Now, if we just recap what we said in the macroeconomic section, there is a major theme picking up momentum, which is global de-dollarization, as countries and economies around the world want to move away from settling trade in the US dollar. So if that was to happen over the next few years, we could see a continuation of a decline on the US dollar index. Historically speaking, the US dollar has always devalued, but it goes through periods of rising in value, especially during times of economic uncertainty, geopolitical tensions, war and conflict. The US dollar is generally the go-to currency as the safe haven. So what we're going to see now is if the US interest rates have peaked and we move into 2024 and we have a period of interest rates tapering off, or let's say we do go into a recession and the Federal Reserve has to cut interest rates later in 2024, the US dollar should weaken, which should benefit Bitcoin and potentially other risk assets, depending on the economic landscape. So major U-turn recently over the last couple of months. BlackRock CEO Larry Fink was actually on Bloomberg, a really interesting interview where he actually was saying that Bitcoin is going to transcend any one currency around the world and sees a broad-based global interest in Bitcoin. Now, you may be aware there's roughly 8 or 9 different spot Bitcoin ETFs pending approval from the SEC. So the SEC is actually under pressure to approve a Bitcoin spot ETF. There's already a futures ETF in America. However, a futures ETF trades off of the derivative. So it's not the real Bitcoin products. Whereas a spot ETF, the ETF actually has to own the underlying assets. Now, if you just take a look at the chart of gold, the gold spot ETF back in 2003, which was the first gold spot ETF, really revolutionized how people invested into gold. So instead of having to go to the bullion dealer, buying gold and having that delivered to yourself, you can invest in an ETF, which tracks the price of gold. Now, we're not saying the same thing is going to happen to Bitcoin, but these ETFs and mutual funds really open the floodgates for billions of dollars to flow into that product offering. Now, if we take a look at Bitcoin in particular, the next Bitcoin halving event in May 2024, when the rewards are going to be dropped to 3.125 Bitcoin per block, it's going to increase the Bitcoin stock to flow ratio. So it's going to make it as twice as scarce as gold and about equal to real estate. So if we pair the fact that we have numerous Bitcoin spot ETFs pending approval, which means there'll be institutions going into the market and purchasing Bitcoin, paired with the fact we're going to have a supply shock next year with the halving event, they're both pairing up to create a major supply shock in the market. Now, yes, the SEC may reject Bitcoin spot ETFs, but the SEC is already under a lot of pressure. They lost a number of lawsuits recently, one against Ripple, notably one over the last couple of weeks against Grayscale, where Grayscale lodged a case against the SEC for rejecting their spot ETF, and the court ruled in the favor of Grayscale. So the SEC have lost a number of battles recently, and they're just kind of delaying the next, the next announcement of the spot ETF. So a lot of pressure on the SEC. We're not saying that it's going to have a similar outcome to gold here, but it really will open the door to much more liquidity to flow into Bitcoin. Now, let's just touch on central bank digital currencies. Now, you may not be aware, but roughly 90% of central banks are exploring central bank digital currencies using the same technology they once downplayed just a few years ago. Now, Ripple appears to be at the front runner, so they're using the Ripple CBDC platform. It's reported that 8 countries are currently building on the Ripple CBDC platform, and they're in talks with additional 30 countries. So if they do continue to work with those 30 countries, it's going to take their market share to roughly 15%. Now, Bitcoin is frowned upon by central banks, but it's due to its truly decentralized nature. Central banks have a lack of control over this specific digital asset. So they can ban Bitcoin mining in a certain area, but Bitcoin mining will just migrate to a different area in the world which allows Bitcoin mining. So, central banks are now developing CBDCs using the same technology that was condemned only a couple of years ago. But, some people, or I guess Bitcoin can't be used as a central bank digital currency due to its decentralized nature. And the concern with central bank digital currencies is they have the ability to track every single transaction. They have the ability to program the currency like coupons. So you have a select amount of currency to spend on certain areas like carbon or meat or wherever they see fit. So central bank digital currencies are coming. I was in a seminar with the Bank of England roughly 2 months ago, and they said by the end of the decade, the central bank digital currency will be in circulation. I personally think it'll be sooner than that. But the end of the decade is really only 6 years away now. So in a short period, we're going to see a rapid increase in the amount of central banks that are pushing out CBDCs. And Bitcoin is truly, I guess, a currency to rival that or to provide you with some freedom outside of a central bank digital currency. Okay, let's get on to, I guess, Bitcoin's 4-year cycle analysis. So if we take a look at Bitcoin compared to different asset classes in America, Bitcoin on the far right-hand side at the top has an annualized return of 144.9%, so roughly 145% per year. There's no other asset class that comes close to what Bitcoin is currently doing. So even in the bear market, with Bitcoin down, I guess it was 80% from its peak it's still producing an annualized return of 145%, roughly speaking. And Bitcoin, I guess, moves alongside other risk assets in a bear market. However, its bear market is slightly more extreme. And we're going to touch on the 4-year cycle in a second. So just going back to the block rewards, remember every 4 years, the blocks and the supply going into the market is halved every 4 years. And this is important to understanding the cycle of Bitcoin and when to invest and when to possibly trim down your exposure to Bitcoin and other digital assets. So here's a chart of Bitcoin that I've shared on my LinkedIn multiple times. Bitcoin is actually trading inside a rising channel structure. Although we've had an 80% decline, it hasn't invalidated any technical structure. If we take a look at the first bull market peak, it peaked at roughly $28 US. It had a 93% decline. Before the halving event in November 2012, Bitcoin's halving price was $12.35. We then had a rally for roughly 385 days post-halving, and Bitcoin reached $1,050. Once it hit the peak, also to note that the majority of the peaks come in October, November, December, so at the end of a year post-halving. So we generally have a large decline after we've had a peak. This declined roughly 86%. We then had the next halving event, which is roughly $650. We then had a rally to 20,000 post-halving, an 83% decline, a move into the halving event at 8,821, and a rally into 69,000. Now, if we take a look at the average lengths of a bear market and a bull market, a bear market on average lasts roughly 1 year. A bull market on average lasts roughly 1.5 years. And Bitcoin on average has bottomed roughly 400 days prior to a halving event. So each red line represents a halving event. Bitcoin actually, in fact, bottoms on average 400 days prior to a halving. So if we take a look at the next halving event, which is due to be April, May 2024, and subtract 400 days, that would suggest that Q4 2022 or early 2023 should in fact have been the Bitcoin market bottom. And Bitcoin since then has bottomed at roughly 15,000. It's had a 100% rally into 30,000. And we're now consolidating around 25, 26, 27,000 at the moment. So Bitcoin is following the previous cycles. And although you're going to see some FUD and some news saying Bitcoin's dead, no structure has been invalidated. In fact, this is an area where people should be looking to accumulate the cryptocurrency going into a halving event next year. Instead of looking at Bitcoin in terms of price and time, this is Bitcoin with price and blocks mined. So as the orange line makes its way out, the more blocks that have been mined and the price scale, notice the price scale here as well, and the price of Bitcoin increases. Now, from halving all the way around to halving is roughly 4 years. But instead of looking at it in years, we're looking at it in blocks mined. So 1 year, it's estimated that in 1 year, roughly 52,000 blocks are mined. Okay. So the all-time highs generally occur 1.5 years after a halving event. So if the halving is in April, May 2024, the potential high in the next Bitcoin cycle should be towards Q4 2025. Now, it's obviously unrealistic to put any price targets on that. So it's more of a case of a waiting game, but also understand that you should be looking to trim down your exposure and reduce your, secure some of your profit, move into a stable coin or to a different asset towards the end of 2025, ready for the next bear market cycle. Following on from that, the bear market bottom has generally occurred 1 year after an all-time high. And it's also roughly 400 days before a halving event. So if we just go back, this would support the chart that in fact, Bitcoin has bottomed because we're moving into the halving event next year, and we should be moving to new highs after that. Now, if Bitcoin does break down from this rising channel structure, obviously that could invalidate this analysis. So we have to be aware of the other side of the coin. If the Federal Reserve continues to raise interest rates, if inflation continues to rise, let's say interest rates go to 6, 7, 8, 9, 10% in the US due to severe inflation, then yes, Bitcoin, on the other hand, could continue moving lower. So although Bitcoin is following its cycle as it has done in previous cycles, there are still obviously some headwinds. So we need to see a tapering off of interest rates going into next year. And we need to see some the spot ETFs become approved. And we need to see obviously the halving event as well. So, I'm not saying go crazy and buy all the Bitcoin you can, but now is an optimal time to start looking to have a digital asset plan in place going into the halving event next year. Another very interesting chart, and this is a chart of Bitcoin against the long-term holders supply. So what we tend to find is long-term holders are generally a key indicator of a bear market bottom and a bull market peak. So when we see long-term holder supply increase rapidly, so if I just go to the market bottoms, we see a big rise in the long-term holders. They're buying Bitcoin. The key thing here is to know they're buying Bitcoin and holding Bitcoin. They're not selling Bitcoin. That indicates it's an accumulation phase, a time to be buying Bitcoin. When they sell their Bitcoin drastically, and we see a large drop off, it also coincides with the market top in Bitcoin. So they've sold their Bitcoin that they've held long term, and they're now waiting for the bear market. So every bull market peak post halving has coincided with a large drop off of the long term holder supply. So they actually sell down their position going into a bull market peak, and vice versa. Once they feel like the bear market is over, they accumulate, and the long term holder supply increases during a bear market low. So now we're at roughly 75-76% of the long term holder supply, which is at record highs. So the long-term holder supply is indicating that we're at like a bear market low at the current levels as well. Okay, a lot of Bitcoin analysis there. We'll just touch on some Bitcoin use cases. Coming back to why should you own Bitcoin? It's at the moment, it's a hedge against currency devaluation. It's a hedge against the Federal Reserve, economic uncertainty, government overreach, especially considering central bank digital currencies, which are coming in the near future. It's a hedge against fiat currency collapse, Argentina, Turkey, China, a few examples. It's also a hedge against banking failures. Over the past year, we've had 5 banking failures. At the same time, Bitcoin has rallied from 15,000 to 30,000 in that period. So Bitcoin is providing a bit of, stability from the uncertainty in the current monetary system. Now, that doesn't mean you should go crazy and buy all the Bitcoin you can. Now, what we want to explain here is you don't need to have a large allocation to Bitcoin to have some diversification. A really interesting article by CoinShares went into detail about a standard portfolio, which is 60% equities or stocks and 40% bonds. Now, this has an annualized return over the past 5 years of roughly 6.9%, a max drawdown of 21.4%, volatility of 9.3%, and a Sharpe ratio of 0.54%. If you add just 4% allocation to gold inside that same portfolio, your returns stay relatively similar at 7%. Max drawdown slightly lower at 20.9%, volatility relatively similar. However, when you allocate 4% to Bitcoin, you more than double your annualized returns. So your annualized returns go from 6.9% to 14.4%. Your max drawdown stays relatively similar at 22.9%. Volatility slightly higher at 10.4%, and the Sharpe ratio at 1.2. So this really kind of explains how you don't need to go crazy and purchase all the Bitcoin you can, but having a small allocation is worthwhile without causing too much risk to yourself, especially whilst you're new to the digital asset space. But I think it also demonstrates how it's, ludicrous to not have any exposure to digital assets as well, especially considering Bitcoin having an annualized return of 145% per year since inception. So, Bitcoin as an investment, whether you're a business owner, a private investor, a retail investor, is probably the number one investment vehicle in the market at the moment based on past data. You can also open up a merchant digital wallet solution. So as a business owner, you can actually take a look at opening up a merchant wallet. So let's say, for example, you wanted to receive payment for goods and services in Bitcoin. This actually opens up a whole new market for you. So merchants who accepted crypto payments saw an average return on investment of 327%, and an increase of up to 40% of new customers. Customers who also use cryptocurrency spend around $250 more per transaction than what the average customer spends with fiat currency. Now, if we take a look down here with remittance, crypto remittance is 388 times faster and 127 times cheaper than traditional remittance methods. So not only are you opening up a new audience to your company, but you're also saving yourself money from the current banking traditional financial system. Now, last slide, I guess, just outside of Bitcoin, there are obviously other opportunities to look at digital assets. And Solana is becoming an institutional favorite. It's second in terms of institutional inflows this year. So Solana has a positive net inflows this year at the institutional level. And it's because of the development happening behind the scenes. So obviously this is a Bitcoin masterclass, but I thought it was important to also note that Solana is also becoming a very, I guess, favored cryptocurrency at the institutional level. Now, Solana Pay is a payments protocol developed by Solana Labs. It now integrates with Shopify. As a new payment method, Solana Pay, a payment protocol created by Solana Labs, now interacts with Shopify. Millions of businesses using Shopify now have access to Solana Pay, a decentralized payment mechanism developed by Solana Labs through the integration of plugins. Now, according to its website, Shopify accounts for 10% of all e-commerce in the United States and 44 billion in global economic activity. There are over 11 million accounts are now active on the Solana ecosystem. And we're seeing significant players like Circle, Phantom have embraced Solana Pay and have payment processes like checkout.com and Sitcom. Now, the transactions on Solana are extremely cheaper for businesses than using the current merchant solution for credit and debit cards. So just another example how a digital asset merchant wallet solution can save your company a lot of money, and how these digital assets are now being incorporated in day-to-day activity around the world. So we've covered a hell of a lot there, Yvonne.
Yes.
So I'll take a breath there, and I'll let you.
Yes. Well, first of all, thank you very much, Anthony. It was really very, very interesting. I'm sure we all learned a lot. I have a few questions that are already put here, so I'm just going to go through that, and then we can always come back to you. So I'm not going to read the names. I'm just going to start with the questions. So, sure. Anthony, the first question is, what do you mean by mined and not mined?
Okay, good question. So mined is the number of Bitcoin that have been, where the blocks have been validated. So you have unvalidated blocks, which are future blocks of transactions, and you have mined blocks, which are previous blocks full of transactions where the Bitcoin inside those blocks has been released to the miners. So let's say, for example, I sent you some money today via Bitcoin, Yvonne. That would go into a fresh block, which hasn't been mined yet. So it's pending miners to validate that transaction. Once that transaction has been validated, those miners receive fresh Bitcoin that hasn't been mined before. So it's fresh Bitcoin, new Bitcoin going into circulation.
Okay, thank you. Next question. I think we've already answered, but I'm going to read it again. Why will there be only 21 million Bitcoin created, and what stops more being created?
So there is a hard cap with Bitcoin. So no one has the ability to go in and code more Bitcoin into the algorithm. There is a hard cap on purpose. Now, what happens is when we get to 21 million, people will then start dealing, instead of one Bitcoin, it'll be half a Bitcoin or a tenth of a Bitcoin or 1% of a Bitcoin to buy and send and receive money in transactions. So ultimately, once all the Bitcoins have been mined, the value of them should be a lot higher than what it is today. And we should be dealing with fractions of a Bitcoin, Satoshis, rather than one Bitcoin or two Bitcoin to send and receive money. So there is a hard algorithm or a hard cap on the supply of Bitcoin that can go into the market.
Okay, thank you. Is there any Bitcoin regulation?
There is a lot of regulation going into digital assets as a whole. Okay, depends on the where you look as well, whether it's the EU, the UK, the US. El Salvador, where it's now legal tender. So there's now a lot of pressure for the FCA here in the UK to provide a lot more transparency and regulation in the digital asset space, which includes Bitcoin. In the EU, they've provided MiCA, which is a framework for companies to work inside the cryptocurrency market. So yes, there is regulation coming, but a lot of cryptocurrency firms work outside of that regulation by being domiciled overseas in a country where there's no regulation. So it depends on whether you're looking at just Bitcoin as a whole or whether you're looking at a cryptocurrency company which operates inside a certain economy.
Okay, thank you. And next question, who set out and who agreed that they will be having event?
Also, yeah, it goes back to Satoshi Nakamoto. So he's an unknown person or a group of people that created the halving event. But I guess it's to do with the opposite of the money supply. An endless money supply results in fiat currency devaluation. It results in inflation. If there's a system where there's a decreased amount of assets going into the system, it has the opposite effect. So that asset becomes more valuable. So I guess it comes down to Satoshi Nakamoto, who coded Bitcoin. If you have a MacBook, you can actually go and open the Bitcoin white paper. They're on every single MacBook, if you didn't know. So you can actually have a read up of the Bitcoin white paper, which details why it does that. But I guess it comes back to Satoshi Nakamoto. So.
Okay, thank you. Next question is, okay, is Bitcoin bankrupt?
Okay. Is Bitcoin bankrupt?
Bankrupt. Okay, not quite understand the question, but any comments on that? I guess not, right?
No, it's not. No, it's not bankrupt. Last time I checked anyway.
Right. So next question is about the slides. So this webinar is being recorded. So we will share the recording on our IoD finance and fintech LinkedIn webpage. And I'm sure, Anthony, that we can also share the slides to those that have provided the email addresses in order to be on this webinar. So yes, that will be shared once the recording is completed.
Most definitely.
Yeah. Following question, what is the correlation between gold and Bitcoin?
That's a really good question. So during times of economic uncertainty, gold and Bitcoin can be strongly correlated together as a risk-off asset class. So, but also gold has an inverse correlation to the US dollar and to real interest rates in the US as well. So gold and Bitcoin can have, or during periods, they can have a similar correlation, but it really depends on a number of factors outside of that as well. So, the US is more to do with the US dollar. Is the US dollar decreasing in value because of slashing interest rates in a global economic contraction and they're trying to stimulate the economy? That's supportive of higher Bitcoin prices, possibly higher gold prices. Or is it to do with a strong economy? And, so it really depends on what's driving the moves in the financial markets. But to sum it up, Bitcoin and gold can go through periods of similar correlation for sure.
Okay, thank you. How is the Web3 related to Bitcoin? What's the correlation?
Yeah, it's completely different, to be honest. Bitcoin is a beast of its own. It's, I would say it's different from the other cryptocurrencies out there. Web3 is this phenomenon where all companies are moving into that Web3 industry to become more digitized and to provide services on the blockchain, where blockchain essentially stores data securely. So Bitcoin is different to Web3, but it's part of the same ecosystem, so to speak. Okay.
Thank you, Anthony. Looks like at the moment there's no more question. If there are any questions, please do feel to type them. Anthony, I wanted to ask you how you and your company can support the Institute of Directors and any of our followers that are here on our webinar that perhaps now listen to your presentation and think, hey, that's a great idea, and I would like to own some Bitcoins. How can you help and how can you support, and what would be the first step?
Yeah, sure. So firstly, you can scan the QR code, connect with me on LinkedIn. We can catch up over phone call. But I guess from an ICONOMI perspective, We work directly with business owners. We provide corporate accounts for business owners, for people that want to hold Bitcoin or digital assets inside their company, either on their balance sheet, or if they want to set up their own personal retail portfolio outside of their business as an investment opportunity. ICONOMI can potentially also help setting up a merchant wallet solution as well. So if your company is interested in receiving digital assets in the form of a payment for goods and services, we can also assist you in that area. So yeah, a number of areas we can potentially help. It depends on what you're looking to achieve. We can help you put a plan together though. And obviously it starts with probably a phone call or a first meeting. So.
All right, thank you. I have a question. Is there any taxable benefit to own sort of Bitcoin in a sort of the business environment? Is that sort of more beneficial from the tax point of view in UK base?
So you need to speak to a crypto tax specialist. I'm not really allowed to provide too much information. However, I can say the following. When you're investing as a retail investor and you're investing from your salary, you've been taxed on the earnings already, and then you're investing with your salary, and then you're taxed on capital gains in line with your tax brand. When you're investing as a company, you're investing pre-tax. You're also then only taxed, obviously, on a capital gains when you sell the asset. So it's more beneficial to invest from a company perspective because you're investing pre-tax. So if I was to be paid £10,000 a month, my tax might be £4,000. I earn £6,000 a month. I want to put £2,000 into Bitcoin, but really that's come from a 10,000 salary. Whereas if I'm investing pre-tax inside the company, you can invest before paying out tax to HMRC. So yes, there's a few kind of pros and cons, but we can put you in touch with a crypto tax specialist who we work with directly, and he works with all of our ICONOMI business accounts as well. So.
Okay, thank you, Anthony. We just had another question. What is the minimum investment that one can invest in Bitcoin? I guess that's within your company and outside.
Yeah, no, simply put, you can invest, I think, from our platform from around £100. So very, very small. There's no pressure to go large. It's down to you what you want to invest, when you want to disinvest and remove your assets from circulation. So yeah, it's fully in your control, a very small minimal amount.
Okay. Does your company actually help manage those investment, or do you also teach your population or sort of your investors how to do that, or do you just simply manage that for them?
No, we have a selection of digital asset portfolios. So there's two different ways you can proceed with ICONOMI. You can build your own portfolio and be in charge of managing your own portfolio, or you can actually use a professional portfolio manager who has a full track record of outperforming the market. It gives you disclosure on asset allocation inside the portfolio. They're in charge of doing the rebalancing. You simply choose when you want to invest, when you want to remove liquidity from the portfolio. There's an instant withdrawal feature, so there's no vested period. So yeah, we can do either portfolio management, or you can do your own, build your own portfolio on the ICONOMI platform as well.
Okay, so if anyone wanted to contact you and contact the company, I guess it's initial sort of free consultation, would you say?
Yeah, fully free consultation. Please feel free to connect with me on LinkedIn or drop me an email to anthony.fernandez@iconomy.com. Free consultation. We can go through, answer any questions. I can show you around the platform, show you some of the portfolios, and yeah, we can go from there.
Okay, lovely. Looks like we don't have any more questions. So once again, I just wanted to thank you, Anthony, very much. It was very insightful, and we definitely have learned a lot. I wanted to thank all our followers, all our members, and everyone who's attended this webinar for joining us. Also, I'd like to thank David for supporting us today. And if there are any more questions, please feel free to reach out. I will put some comments and sort of the video on our LinkedIn page, which is the IoD Finance and FinTech LinkedIn page. And if there are any questions, please put those questions in the comments, and I'm sure that Anthony will be happy to answer that. And if you have any questions in terms of IoD membership and all the benefits, please feel free to reach out to us as well, and David will give you all the necessary details. So once again, I wanted to thank everyone and wish you very good evening. Till next time. Oh, I forgot. We have a few upcoming events, and this will be advertised on our page. The next interesting webinar is actually about NFTs and blockchain, which will be held on 10th of October. Also on the webinar. So please feel free to register for that. And once again, thank you. Until the next time.
Thanks, everyone.